So let me paint the picture for you. You're looking at a chart and you can see that it's currently forming the most perfect symmetrical triangle. So you look left and you see that before this triangle was a massive push up. So this leads you to believe that the likelihood of the next move out of the triangle is going to be another push up. However, because you're a trader, you know that there is probability and also possibility. So this symmetrical triangle could also be the beginning of a trend reversal, and the next big move out of it could also go down. Now at this point, if you already have no idea what I'm talking about, as much as I would love for you to continue watching this video and help me with the algorithm gods, I care more about your success than that. And so I'm going to ask you to stop and go back and learn to trade properly. What I'm showing you in this video is a fairly advanced strategy, and so you need to have a good understanding of technical analysis in order for the rest of this to make sense. So if you are looking for recommendations on where to learn and you want to know about the education company that I'm a part of, head down to the description of this video because the first link will take you to learn more about that. And I also have my email down there if you want to have a chat about it first. So feel free to reach out to me. Moving on, I'm going to assume that if you're still watching, you do have an understanding of trading, at least at the most basic level. So back to this symmetrical triangle. Because it's symmetrical, you can't form a definitive bias on which way it's going to break out. But you know that it's going to be strong, and whichever way it breaks out, you want to be a part of that move. This, my friend, is where hedging answers all of your prayers. So hedging is a technical term which basically means protecting your profits in the event of an adverse move. And there are a number of ways to do it. Hedging allows you to open both a long and a short on the same asset at the same time. Meaning that in the case of the example that I've given you earlier, you could catch the breakout of this triangle regardless of which way it breaks out. And in this video, I'm going to show you a couple of ways to do exactly that. Now, as always, before we head over to the charts, if you're enjoying this video, please smash the like button below. It will help me with the algorithm gods, as I am still a fairly new YouTube channel. And also hit the subscribe button and the bell so that you can get notified of every time that I upload. With that being said, let's head over to the charts. Okay, so here we are, we have that fairly perfect symmetrical triangle, and we know the breakout is going to be fairly big. We want to catch it either way as we're starting to come into the pointy end of the triangle. I'm going to mark in my support and resistance first. Now, as you can see, that lines up with the breakout of these triangles. Now, in doing that, because I can see the price is squeezing between these two lines, I basically want to set a long if we break up past that line, which would essentially also take us out of the triangle. And I want to open up a short if we break out down, doing the opposite. I'm not going to worry about target just for now. I'm just looking at the entry position. So I'm going to set a long position just a little bit higher than where I have put resistance. And I'm going to put my stop loss at support. And the reason is because if we break down below support, I don't want to stay in my long anyway because I got it wrong. So I want to be out as soon as possible. My target is going to be at the previous high. So I'm just going to push it up to about here with mini targets along the way. So I will be checking when price hits here, and I will be checking when price hits around here as well. So that's going to be my potential long position. My short position, should it break out downwards out of the triangle, is going to be a little bit lower than where I have put support. Now, I know that there are wicks in this area, but I'm using this because this is the most recent low. And the same thing, I'm going to put my stop at resistance because if I'm wrong, again, I don't want to stay in this trade. I want to get out. My target for my short would be ideally somewhere down here, but I do know that I have all these wicks to deal with. I'm just going to put it somewhere around there. Now, because the price is currently lower than where I want to enter to go long, that means I have to enter a buy stop. And same in reverse, because it's currently higher than where I want to short, I have to enter a sell stop. So what this means is that if price now continues through this triangle like this, and then breaks out of it down, as soon as it hits
this price here, it's going to open up my short and it's not going to do anything with my long. So I don't have to worry about that. And so now I'm in a short trade and I could just go in and cancel my long order because I've picked the right way. The same goes the opposite way. If price did this instead and then broke up, my long order would execute, but my short order would still be sitting there. So I would just go into my exchange and cancel out that. And now I'm just sitting in the right order. The danger of doing this is that price could potentially do this, which means now it's picked up my long order, come back, hit my stop loss on that long order, pick up the short here at this level, and then continue up. That's highly unlikely, but it is possible. So what that means is you would get stopped out of both trades. So it is something to be wary of with hedging, and that is why I say you really should only do this if you're an advanced trader, because you need to be really, really good at picking your entries. So worst case scenario, that's what could happen. Best case scenario is it continues, picks a direction, and you've caught it, regardless of what that direction is. And now you're in a trade and the other one is cancelled. All right, so that's one option. The other option is if you're willing to take a small loss in exchange for a big gain, you can enter a long and short at the same time with a small stop loss either way, so that whichever way it continues, you will get stopped out at a small loss, but you will make up for that in your gain. So for example, if you were to set a trade that with a 1% stop loss, but your target was 5% both ways, you know you're going to lose 1% and you're confident you're going to gain 5%. So the overall win will be 4%. And so this is how you would do that. So picking where the middle of the triangle is, which is basically where the point would be, you're going to enter a long and a short at the same time. So you would open up a long here down to your target. You're still going to have your stop just a little bit above where you put resistance. So that's at 2.15%. You want to have your stop the same in both directions. And then if your stop's going to be 2%, in order to do this style, I would want a 3-to-1 trade. If I couldn't get that out of this, I wouldn't do this option. In this situation, let's pretend we did have that. And now I'm going to put the long in the other way. So that would be my long and short, and I'm opening both at exactly the same price. Now again, on BitMEX, I would do that on 2 different contracts. In Binance, it's a little bit different, and I'll be getting to that shortly. So now what you're saying with this trade is, I know one of these is going to be wrong. And I know that I'm going to get stopped out on one of them. It's okay because I would still be happy with the profit of the other. That's what you're telling yourself. So this trade would continue like this, and then it's going to break out one way and make a decision. So you're going to end up hopefully hitting your target on your long, and it's going to make this loss irrelevant. Now, as I said, this is not my preferred way to hedge, and I would only do this if the target both ways could be masked, and that target is decided by looking left, and therefore that's why you need to be an advanced trader. Now, the last way to hedge would be to pick a bias already. So just say in this, if you look left, okay, we came from a strong uptrend, okay? So probability is that this will probably break out upwards. So you're going to open a long because of that, okay? So you're getting to the pointy end of the triangle and you decide, all right, off this support, I'm just going to go long. So you're long here from this candle with your target being up somewhere up there. And you're going to have your stop loss below these candles here. So you're in a long trade now. But what you're saying to yourself is, if I'm wrong and that flicks out the other way and goes short, I want to open that short after I have taken that loss. So what you then do is you work out where the next level of support would be, and then you're going to open a short, or you're going to set a sell stop in advance just below that level and have your stop where your original entry was. So what this means is that if you were wrong here, you're going to get stopped out for 2.5%, but you're going to catch the rest of the move down, which will make up for it. So then that would become your trade. So this trade would get cancelled as a loss. As soon as it closed out in loss, this one opens up and basically is your recovery. So that's the third way how to hedge. You can also use this method for supply and demand zone. Okay, so just say this is what you have identified as a potential order block. Once price gets back here, something big is going to happen. It's either going to push up with big momentum and continue up, or it's going to reject off and head down. But your bias is that it's going to reject and head down. What you could do is set a short order here at the bottom of that order block so it picks up, with your target being back to previous support, and have your stop just above the little wick of the most recent area. So that's going to be your trade. However, you also know that if the momentum keeps up like this, with the green candles growing in size, it could be strong enough that it pushes right through. So in that case, you would put your buy entry, which would be a buy stop, just above the order block, above the wick, and your stop below. Regardless of what happens, these two are going to be really good trades because your stop is under 1% on both of them, and the target is quite massive on both of them as well. So you're willing to take this risk, lose out on one of them for the potential of the other. So now if we let that play out, okay, so at this point it's picked up that short here. It's picked up the short, and we're waiting for it to get to our target. Now, if you weren't on the ball and you didn't take profit, price would have come back up and you would be stopped out of this trade, but you would have picked up your entry on this trade. So you may not care so much right now. But that's how you would do a hedge using a supply and demand zone using buy and sell stops. So those are your three options. Okay, so I'm going to head over to the USDTM futures. And from here, you're going to head over to these three little dots up the top. And you're going to click on position mode. And then you're going to click on this option for hedge mode and click confirm. Now, in order to do that, you need to make sure you have no current positions open. What that does is that opens up these two tabs here for open and close. And what that means is that you can now open a trade in both directions on the same pair very easily. Now, for the type of hedge where I said you're just going to get in immediately with a small stop on both directions, you can do that as a limit order or a market order all in one go. Now, I'm going to do it as a market order just so that I can show you the entire process and have it filled immediately. But if you want to set the price that you get in, you would do it under limit. So for a market order, I'm first going to set my long, and I'm just going to put in 0.001 BTC. Again, I'm going to check over here my margin, whether I'm on cross or isolated, whichever one you want to be on, and also adjust the leverage to whatever you want. I'll leave that on 10x. So always double check that before any order. Now coming over here, I'm going to put in how much I want to buy, and then I'm going to tick on this little box here, which opens up my take profit and my stop loss. Now, when I click on open long, that's going to execute this order at the current price, and it's going to put my take profit and my stop loss straight in all in one go. I am on the open tab because I am opening a new trade. Now, if I wanted to close an existing trade, I would click on that one. Okay, so once I click on open long, that's now gone in. My open position is here, long. That's my entry price that I got in at. And if I click on open orders, I can see my take profit and my stop market is there already. I can also click on view here, which will bring up the entire order. And if I want to change anything, I can go to my open position, click on this little pen icon here, and I can put in a new take profit or a new stop loss. Once I do that, however, I will then need to go to open orders and cancel the existing one. So my long position is now opened. I'm going to now also open a short position, and now I'm going to click on open the short, and you can see here that that has now popped up and opened a short on the same pair. Also on my chart, as long as you are clicked on trading view here and not original, you can see the entire order on your chart as well. So that is how you open both a long and a short on the same pair in Binance. Now, if you wanted to do the buy and sell stop, that's a little bit trickier. In order to do that, we need to go to stop market up here and enter the price that you want to go long at, which needs to be above current price, and you're going to click on open long. Now, you don't get to set your stop and your take profit in the same order with a stop market, so you will need to go and do those separately. This is only opening up your entry. And then if you wanted to open a sell stop, you would enter the same way and then click on open short. So that's now got a buy stop above current price and a sell stop below current price. And then as you normally would, you could go in and set your stop losses and your take profit. You can also use stop limit or stop market to set that as well.
So there you have it. Now you know how to hedge. Once again, hedging is a fairly advanced strategy, so if you are not confident, please don't try without learning properly. It will save you a lot of money by learning from experts who have actually become profitable in this industry. And again, if you are looking for a recommendation, have a look at the description underneath this video, and my email is also there if you want to book a time to talk. And if you are an advanced trader and you want to know more about trading on Binance, have a look up here somewhere. There will be a link to a full Binance tutorial video that I have done previously, and you can check that out. Until then, safe trading.